So let's get started. Hello, good morning to all the people from Europe, good afternoon to everyone in the Middle East, and good evening to everybody joining in Asia and Australasia. My name is Kieran McDiamond, and I'm going to be hosting today's session alongside Darren Jones, where we're going to be looking at some of the key points from the UK spring budget, which came out last week. For those of you who are clients, you'll be pretty used to seeing Darren Jones's face. You might have joined webinars in the past or attended some of his sessions, or in fact, had direct meetings with your advisor and Darren to look at some tax planning elements or trust planning elements of your portfolio. For those of you who haven't joined us before, or perhaps this is your first interaction with De Beer Group as a company, I'd like to say a very warm welcome, just provide a brief introduction on what we do. So we are one of the world's largest independent financial advisories, and we predominantly help expatriate clients with the protection and growth of their wealth in a tax-efficient fashion. Now, today, Darren's going to be going through some of the key points from the spring budget. As he said just before, he had the pleasure of going through the 130-page document that was released by the UK government last week, and he's going to be covering some of the key changes, which predominantly relates to pensions, including changes to the LTA. So without further ado, Darren, I'll pass over to you now to get started with your session.
Super. Thanks, Kieran. So good morning, good afternoon, good evening from me as well. So I'm going to go through today the changes that happened in the budget last week that will mainly take effect from the 6th of April this year. So I put together a basic agenda, and I'll be taking a Q&A session at the end, as I think Kieran just mentioned. But I'm going to go through a summary to start with of the key things that the Chancellor announced that are not necessarily directly relevant to us as primarily British expats living abroad, but just out of interest purposes, just a few things that he raised in the speech and in the budget notes afterwards. The significant changes I've already mentioned in the pre-webinar chat was around pensions, the lifetime allowance, and the lifetime allowance tax charge particularly. There's a few previous announcements from mainly the autumn statement last year that have now been confirmed and will come in April, so I'll do a quick reminder of that, and then just stress how important it is now that we do some planning and you take formal advice before doing anything major, particularly in relation to pensions. So what was the strategy within the budget? Well, the strategy was basically a growth strategy for the economy, but I think the key message coming through clearly to me was to encourage people in the UK back to work. So post-pandemic, we are now trying to get people back to work who have got used to maybe working at home or not working at all and don't want to necessarily get back into the workplace. Also younger people, encouraging them into work, and particularly with childcare being extended, the free childcare being extended and so on. So you'll see the messages as we go through the presentation. It's I would suggest primarily around those 2 points, growth, but even more so encouraging people back to work. So I'm going to save the first bullet point to last, actually. The changes to the pensions lifetime allowance is what I want to major on today. But just to quickly whiz through all of the other things that were announced in the 130-page document that Kieran mentioned. Usual changes to things like fuel and alcohol and tobacco duty. Some were frozen, some were just raised slightly. In fact, I think one was reduced. There's a £2,500 cap currently on household fuel costs in the UK. That's been extended for another 3 months on top of what was announced last year. Fuel costs on prepayment and post-payment meters now are equalised, so the members of the public in the UK who are perhaps least able to cope with higher charges were actually being charged more for being on a prepayment meter than anyone who is on a standing order direct debit basis. Now the price has been equalised for all people. There's £20 billion have been allocated there for low carbon energy projects and also carbon capture over the next 20 years. Nuclear energy has been reclassified as environmentally sustainable, arguably a bit of a debatable point, but for investment purposes, that is now deemed to be environmentally sustainable. And they've also extended the free childcare to a little longer and for younger children. Childminders now are able to look after more children. So I guess both that point and the previous one are encouraging the younger members of the population who are perhaps stay-at-home mums or dads to go back to work. So now childminders are able to look after more kids, and that will just obviously increase the capacity and hopefully reduce the cost perhaps for people who want to send their children into childcare. Tougher requirements on the unemployed to go out looking for work. So to maintain the benefits that they might be on, they have to be proactive in looking for work. £63 million has been allocated for programs to encourage retirees over the age of 50 back into work. So we're used to people being on apprenticeships being younger. We've now got returnerships for those that are over the age of 50 and want to retrain and go back to work as in the latter part of their days in their career. Immigration rules have also been or are being slightly relaxed, particularly around the construction industry. So post-Brexit, slightly harder for some European workers to go into the UK. That's been eased somewhat for the construction industry. Corporation tax rates, the rises that were announced last year, in fact, the year before, I think, initially, are now being implemented from April. So the 25% corporation tax rates on profits over £250,000 will come in, and there's a sliding scale between 19% and 25% on any profits over £50,000. 12 new investment zones are being introduced around the UK, so akin to the Canary Wharf and Liverpool Docklands projects that have been seen as successful in the past. There's now going to be 12 further investment zones. Defence spending, that's been announced to rise by a further 11 billion over the next 5 years. Scarily, there are some prison sentences now for those that are convicted of marketing tax avoidance schemes. So there's something been in place for a little while now called DOTAS, which is a disclosure of tax avoidance schemes. So in order to market extensively a scheme shown to be avoiding legally tax, has to be reported formally to HMRC. And there are now some prison sentences in place if you start to market those without prior approval and disclosure. £200 million has been allocated to make our roads a bit smoother, so to repair the potholes, and 900 million for a new supercomputer facility, which is going to be aiding the UK's artificial intelligence industry. So those were the key points, aside from pensions, that were announced in that post-budget document. Economically, the Office for Budget Responsibility have put some forecasts out there. So they're suggesting for 2023, at least, there'll be no recession in the UK and that the economy will shrink slightly by around 0.2%. The growth is expected then to return in 2024 at 1.8, up to 2.5 in 2025, and then back a little bit down to 2.1 positive in 2026. So they are the forecasts based on the announcements that the Chancellor made in the budget last week. Inflation was predicted last week to fall to 2.9% by the end of 2023, based on the changes that he's making in the budget, which was down from 10.7% in Q4 of 2022. But some of you may have seen there's been a little uptick today. It's gone back up from 10.1 to 10.4 for last month. That's just been announced about an hour ago, which is a bit of a surprise and is apparently down to the cost of food and eating out and such like, which has been slightly higher than expected. So that's a bit of a surprise, but nonetheless, it's just gone up slightly by 0.3% month on month. The debt forecast for the UK will be 92.4% of GDP this year, rising to 93.7% in 2024. So that's all kind of perhaps reasonably interesting background, but what about the major changes that are affecting us as expats, and particularly around our pensions? So this is the pension changes on the screen now for people who are resident in the UK already, or who may go back to the UK and perhaps continue to save into their pensions in the near future. So we have this thing in the UK now called the annual allowance. You are allowed to contribute up to £40,000 per year into a pension contract and get tax relief on it. You need to be earning 40,000 in order to do that, but at least you can get tax relief on the contribution up to 40. Anything you put in excess of 40,000, you would not be able to claim tax relief on. They're increasing that annual allowance from 40,000 to 60,000 as of April this year. As of the turn of the tax year 2023, that will increase to 60,000. We also have something called the money purchase annual allowance, and that's increasing from 4,000 back up to where it used to be at 10,000. What that basically is for someone who has already drawn down on a pension, so you're maybe taking some flexi access drawdown, making use of the pensions freedoms that were introduced 7 years ago. If you've made use of that, you were unable to fund your pension to the extent that someone who hasn't drawn down on their pension was able to. So the 40,000 did not apply to you, still does not apply to you, but it was limited to 4. It's now being increased to 10. Again, it's to encourage people back into work who may be going back part-time, maybe they're supplementing that income with some pension drawings. You are actually still able, if you wanted to put in up to £10,000 a year to a pension and claim tax relief on it. The tapered annual allowance is less used, but nonetheless is being increased from 4,000 to 10,000 also. That is for high earners. So typically the formula is quite complicated, but we have this definition of adjusted income. And let's just think of it as earnings. If you earn more than £240,000 a year, you are not able to put 60,000 soon to be as of April in. The annual allowance was reduced, and it was actually reduced at a rate of £1 for every £2 that your earned income exceeded, or your adjusted income exceeded to 40,000. So that's obviously for the higher earners. That's being increased to 260,000, and therefore the tapering will kick in £20,000 later on, but it will still taper down, but only as low as a minimum of £10,000, not down to the 4,000 that it was previously. So anybody will be able to contribute at least £10,000 to their pension, even the seriously high earners. What is most relevant to us as expats, though, is that the headline, at least, was that the lifetime allowance is to be abolished. So currently, we have a lifetime allowance of 1.0731 million. If our pension pot, if it was a money purchase pot of money, is in excess of 1.0731 million, well, then you had a potential tax charge called the lifetime allowance tax charge on the excess. And if you had a defined benefit scheme, then it was the amount of pension that you were able to draw multiplied by 20, which was tested against that same just over 1 million lifetime allowance. But what they've said is they're going to abolish the lifetime allowance. That was a headline. Actually, what they're doing from April is they're amending the lifetime allowance tax charge. So if you drew the excess over your lifetime allowance as income, they would tax the excess value. So let's say your pension was worth 1.5, and let's say the lifetime allowance was £1 million for ease of numbers, £500,000 is hit with a lifetime allowance tax charge. And if you drew that benefit as income, it's at 25% plus income tax on what you draw. And if you draw it as a lump sum, it's simply 55% on the lump sum with no further tax. Actually worked out to be almost the same number if you're a higher rate taxpayer in both scenarios. So the key thing here is that is being reduced to zero. So the lifetime allowance tax charge will be zero as of April this year. So great news for anybody tuning in today who has a pension with a value in excess of the lifetime allowance, which is 1.0731 million. You can have some protections in place which might make it a little higher. I'll come back to that on the next slide. But that's that is the number that most people have applying to them. They've also gone on to say that the lifetime allowance itself will be completely removed at and I quote, future fiscal event. I think the expectation is that that will be next April. And it's probably because the legislation is quite difficult, quite complex, and to draft it such that it's removed by April this year, maybe a little bit of a step too far. So therefore, it's next April that they're proposing, or a future fiscal event, they're proposing to remove that. I'll come back to my slightly skeptical view on that on the next slide. So basically, there is no practical difference there between removing the lifetime allowance totally and reducing the excess charge down to 0%. It has the same effect. There is no tax for you to pay if you draw down on your pension and start to, for example, take a lump sum, pension commencement lump sum, what we used to know as tax-free cash, or indeed start to draw an income, or indeed maybe transfer away to a QROPS, which I'll come back to, qualifying recognised overseas pension scheme. So if the lifetime allowance is to be abolished, when will it happen? Well, I've already mentioned the future fiscal event. The expectation is it will be this time next year in the 2024 spring budget, but it's not certain. What would happen, though, if we had a new government? So let's say Labour were elected or another party came into power. Could they reverse this? I think there is a significant likelihood that Labour will. They've already said they will vote against these changes as it passes through Parliament. I suspect that will not work and that the government will get it through, and therefore it will be abolished from April, or at least the tax charge is reduced to zero from April. But who knows, it may be introduced again if Labour got into power in the future. So I think there may be I don't wish to be a sort of scaremongering here, but there may be a window of opportunity for people with a higher pension value to maybe create what we call a benefit crystallization event, a BCE. Basically, you're drawing down in some form on your pension and crystallize that value against the lifetime allowance whilst the tax charge is zero. So anybody who is at or close to, or more importantly, above the lifetime allowance, very important that you take some advice over the next 12 months, because we know in the coming fiscal year, you're going to be able to do that without there being a tax charge. No absolute guarantees that there will be beyond that, particularly if they don't abolish the lifetime allowance totally, or indeed if Labour get back into power at some point soon. The other thing that is worth mentioning is you can still apply for fixed or individual protection, which goes back to 2016. So if your pension was worth in excess of £1 million in April of 2016, or if it wasn't, but it was quite close to the current lifetime allowance, it's worth applying for either individual protection in the former example where your pension was over 1 million, or fixed protection if your pension was less than 1 million in 2016. And there are certain rules around that, such that you can't have contributed again since April 2016 in order to apply for fixed protection, for example. You can't contribute to your pension going forward either, but it will allow us to fix your lifetime allowance at 1.25 million in that particular example. There are different protections you could have applied for over the years, since 2006 when the lifetime allowance was introduced. But it's important that we don't do something going forward that would jeopardize that protection. It may never be relevant anymore because the lifetime allowance is likely to be abolished. But as I said, if a different government came in, or maybe that future fiscal event never transpires in the way that's intended, well, then maybe that lifetime allowance could stay in place and you may not be able to apply for fixed protection forevermore. So why not apply for it now whilst you can, would be my message. We also have something called an international enhancement factor, which is most relevant to the lifetime allowance recovery charge, the tax charge. And where you have accrued benefit, particularly in a defined benefit scheme as a non-UK resident, any value that you accrue whilst non-resident, you can increase your lifetime allowance by. You have to apply for that within between 5 and 6 years after leaving the scheme. So if you are in that position and you have some pension benefits that have accrued as a non-resident, I would suggest strongly that we apply for your international enhancement factor as soon as possible, just so it's there in the background. It may never be needed because they may abolish the lifetime allowance entirely, but maybe not. So let's again, same as fixed and individual protection, let's apply for it whilst we can. But it is an enhancement factor, it's not a protection. There's a distinct difference I'll come back to on the next slide. So I said cure-ops is a possibility, qualifying recognised overseas pension schemes, and what effect does this have on cure-ops? Well, one way that an under 55-year-old can create this thing known as a benefit crystallisation event, a BCE, is by transferring their UK scheme out into a cure-ops. It's tested against lifetime allowance. You can do that over the next 12 months if you have a higher value, and then you're out of the UK system. You're not then subject to any subsequent changes that apply, most likely. You've crystallized it against the lifetime allowance with zero tax charge, whilst you definitely can in the next 12 months. So I think cure-ops definitely do have their place. There are restrictions. You've either got to live in the EEA or possibly the UK or Gibraltar as well, or you have to live in the same jurisdiction as the cure-ops. So people in New Zealand and Australia, for example, use cure-ops quite regularly. So again, really important that you take advice on this. If you're contemplating a switch of your pension out of the UK and into an overseas scheme, you need to take some advice. And I would definitely suggest doing so in the coming tax year, whilst we know there are no excess charges to apply. So is there any sting in the tail for these changes? Well, I don't think it's a particularly big sting in the tail, but it could become slightly so as years go by. So the pension commencement lump sum, PCLS, is what we used to and sometimes still call tax-free cash. The tax-free cash that you can take is limited to 25% of either your pension fund or the lifetime allowance, whichever is the lower. So if you had a bigger fund, you're only able to take 25% of whatever your lifetime allowance is. So for most of us, that would be 1.0731 million. Now, so 25% of that number, by the way, is the fairly unmemorable number on the screen there, which is £268,275. So that is now going to be frozen. So your pension commencement lump sum will no longer be 25% of your value or 25% of your lifetime allowance. It will be capped at £268,275 as an absolute maximum, unless you have in place some protections from as far back potentially as 2006. So if you've got fixed protection 2016 that I was talking about a minute or two ago, then you would have a lifetime allowance fixed at 1.25 million. You are still able to take 25% of that. But you need to be really careful when you repatriate to the UK, especially if you go back and continue to work with auto enrollment there. If they enroll you back into a UK pension scheme, then any fixed protection you already have in place from being an expat perhaps will be lost. As soon as you put or accrue any more benefit into a UK scheme, even a small tiny amount through auto enrollment, you lose that fixed protection. So again, really important that you take some advice on this before you go back to the UK, or even as an expat. Let's just be aware of what our options are should we go back to the UK. The international enhancement factor I've mentioned already. That's the amount that you can accrue as a non-resident accruing benefits in a UK scheme. That is an enhancement though. So if you have an international enhancement factor in place, that does not help you as far as PCLS is concerned. The 25% will still be limited to whatever your basic lifetime allowance is, whether that's the 1.073 million or whether you've got fixed protection or some other form of protection. It's limited to 25% of that, not whatever it's enhanced to by the international enhancement factor. So that is very likely to now become redundant. It shouldn't be needed, but I would definitely encourage you to apply for it and have it there in the background, just in case anything changes, perhaps with a change of government, for example. Now, if we look at the actual tax take, the revenue the Exchequer are going to lose as a result of these changes, it looks on face of it like a fairly substantial number, but it's not actually in terms of the UK's overall tax take. So by 2027-28, the removal of the lifetime allowance tax charge is expected to cost £835 million. On top of that, the annual allowance being increased from 40 to 60,000, so the tax relief being given on that extra 20,000 contribution, expected to cost 290,000. And the amendment to the money purchase annual allowance, that's where people are going back to work and have already drawn down their pension, so they can now contribute up to 10,000 instead of only up to 4. That's deemed to be or expected to cost about £40 million a year. So we're talking about £1 billion or so. So not an insignificant number, but it's in the overall tax take. It's probably around about 0.3% or something of the UK's tax take that this is going to cost the Treasury. So I guess that is one thing that Labour would certainly look at when they're re-elected. This is aimed and, of course, most beneficial to high earners and those with large pension schemes. And typically, traditionally, Labour have not looked after that particular demographic. So I think it's quite feasible if they did get re-elected, they would seriously look at reversing some of this stuff. Okay, so that's all I had to say around the pension changes from the budget. Just a quick look now at changes that were announced in the autumn statement. So this now becomes effective from the 6th of April this year. So they've reduced the rates or the level at which the additional rate of income tax is charged. It is currently at 150,000. That's being dropped to 125,140 pounds from April the 6th. And it also means at that level that you have lost your income tax allowance. So the £12,570 income tax allowance, as soon as you're earning in excess of £100,000, starts to reduce. And as soon as you hit 125,140, it's completely removed. They've frozen all of the allowances as well. I say all, the majority of relevant allowances until April 2028. So the personal income tax allowances, 12,570, the bandings at which they apply before you go into 40% tax, for example, are fixed. National insurance levels are fixed. Even the inheritance tax nil-rate band, and that's been fixed now since 2009, but the projection is, the anticipation is that will be fixed now until 2028 at least. They've also announced that as of this April, the capital gains and dividend allowances will start to be reduced. And also they confirmed that the pension triple lock will be maintained. Just a couple of points on that. So from a CGT point of view, they're reducing the allowance, the amount you can realise in capital gains as a UK resident from 12,300 currently. It drops to 6,000 on the 6th of April, and it drops to a further 50% to 3,000 in April 2024. That's mainly relevant for those who become UK resident, but it also applies to anybody with UK situs property. So anything that's not your main residence that attracts capital gains tax main residence relief, and most of us won't be in that position. If you've got a buy-to-let or a house that you rent out now, maybe it used to be your main residence, but there probably will be some capital gains to pay on that when you eventually sell it. And the allowances have been reduced. For property as well, the rate of capital gains tax is 8% higher than it would be on any other type of asset. So a higher rate is 28%, basic rate is 18% on property. So again, some planning to be done there. Maybe there's an opportunity to move back into what used to be your main residence when you go home and potentially avoid some of that capital gains tax. Again, let's speak about that, some planning opportunities if you do so in advance of return. So please do shout and let's speak to one of our advisors, or indeed I, if you wish to as well, before you, as far in advance of repatriation as possible. Dividend allowances, so this is the amount of money that you generate in terms of dividends on direct equities or possibly on mutual funds, unit trusts and OICs and so on. They're reducing that also by 75% from its current level of £2,000, dropping to £1,000 in April, dropping to £500 the following year. It's becoming harder and harder to take advantage of these allowances in terms of the investment platform that you use when you're back in the UK. So historically, if you had a portfolio of maybe, let's say £100,000 worth of mutual funds and shares and such like, well, as long as you're not making 12.3%, if I just go back to the previous slide, 12,300 as a percentage of 100,000 invested. If you're making 12.3% a year or less, you can use your capital gains tax allowance and avoid some tax on the gains by reinvesting each year. Well, once that drops down to 6 and then to 3, obviously that becomes less and less viable. And it's the same with dividends. Even basic S&P index tracking funds, for example, they're still producing a dividend. And if you've got 100,000 invested, you're only going to be able to raise or receive a dividend of 0.5% a year when the allowance is 500 before you're in a tax position. So it's just becoming harder and harder to realize gains on a UK portfolio or as a UK resident with a portfolio probably anywhere in the world, frankly. And avoid those taxes. It's becoming harder and harder. So again, we have some planning opportunities. Many of you who have tuned in today will have international portfolio bonds, for example. We use those extensively for British expats to at least defer the tax liability and almost certainly ultimately mitigate some or all of that tax liability when you're back in the UK. Again, super planning opportunities, but you must speak to us as far in advance of repatriation as possible. From an inheritance tax point of view, I mentioned the nil rate band. It's been frozen at £325,000 now since it was increased back in 2008 from 312 to 325. So basically, it will be 20 years with no increase. They did allow us to have a residence nil rate band that came in a few years ago of an extra £175,000, but that's only applicable on a main residence that's left to a direct descendant, such as a child or a grandchild or a great-grandchild. Again, very important that we talk and plan. So many planning opportunities around inheritance tax. I think there was, I forget the name now, but there was a previous chancellor that actually referred to inheritance tax as a voluntary tax. It's something you only pay or your beneficiaries pay if you fail to plan. It's actually reasonably easy to plan as you get into your older years to avoid the inheritance tax. Again, shout up and we can help you with that. One element of, for sure, great news for those that have a state pension in the UK is that the pension's triple lock has been maintained. They announced this back in the autumn statement. So your state pension now is going to increase every year by either the higher of 2.5%, national average earnings, or most importantly right now, inflation. So it's going to go up by 10.1% in April this year. You need 35 years worth of national insurance contributions in order to get the maximum state pension, but you can backdate that and we can help you with that as well. Again, important that you take some advice. So I think for me, the message that came out of the budget is that they're going for growth, but most importantly, they want to get people back to work. And all of these measures are aimed at UK residents to get them back into work post-pandemic. And it's so important now that planning is done as far in advance of repatriation as you can, both with the allowances that I've just gone through for capital gains and dividends, for pension planning, lifetime allowance, maybe transferring into a cure ops if you're in the position to be able to do that, It's really important. So please shout out. We've got some really great advisors now around the world, probably located in the country where you are. We've got myself in the background and the team here that can help out as well with joint meetings over Zoom and such like. The globe is so small now that we've got Zoom in place to do that. So more than happy to get involved with any meetings that you wish to have after this presentation. So that's me done. Kieran, I can see, has just popped back onto the screen, and I think we're now going to go into a Q&A, Kieran, aren't we?
We're still waiting for that first question to come in. So I'll give you just a minute to catch your breath on that. But just use the Q&A facility at the bottom of your screen. There we go. There's the first one. Okay, so have the Conservatives reduced the tax to GDP from the highest since World War II? If we continue to be taxed this high, what should we do to mitigate this?
Stay as an expat, maybe. So I'm trying to work out what exactly Jonathan is meaning there. So they've reduced the tax towards GDP from the highest since World War II. That's not a stat I've actually seen, to be honest, Jonathan. I haven't really given that a huge amount of thought. So what should we do to mitigate it, to reduce the taxes? I mean, we've got loads of plans that we can use for mitigating tax liabilities, whether that's on investments or on earned income contributing to a pension. One thing I didn't mention actually, Kieran, is when you're back in the UK, they've reduced they've increased the annual allowance now from 40 to 60,000 pounds. However, when you go back to the UK, there's an opportunity to mop up. You can carry forward any unused reliefs as well. So maybe going forward now, if you don't contribute in the coming years, when you move back to the UK in years to come, you can mop up any unused reliefs that you've not made use of in the previous years. You need earnings in order to do that. But I think probably in better answer to Jonathan's question there, we need to sit down personally and discuss your individual circumstances and what sort of taxes you're actually concerned about before we can really talk about how we mitigate that, I guess.
Yeah, fair enough. Okay, so the next question comes in from James, who says, did you say that if Labour gets in, the lifetime allowance will be brought back in? So am I correct in thinking that urgency is key for bigger pensions? And if that is the case, then we need to transfer them as soon as possible.
Yeah, I think that's a really good point, James. So Labour have already said that they're going to vote against this change, although they'll probably fail to stop it in the short term. But there is a significant chance, of course, they could get re-elected, and they've stated that they have no desire to cost the Exchequer over £1 billion a year to help out the higher earners that are basically getting tax relief on their pensions. So yeah, I think urgency is key here. Over the next 12 months, from April the 6th to April the 5th of 2024, we definitely have a window of opportunity there to for sure avoid any lifetime allowance tax charge. Whether we'll continue to have that beyond April 2024, well, we need to see what happens in future budgets and indeed who is in power in government in the UK.
Okay, next question is, could we see any other tax cuts in the UK? Are we expecting any other tax cuts in the subsequent budgets that we'll see?
No, I think not. I think the fiscal position in the UK now is they need to get as much money in as possible to recover from the pandemic, to stem inflation. There's no expectation that they'll try to feed more money into the economy. I mean, we had the Truss and Kwarteng approach, which the press and the other politicians basically just handed them out of power, didn't they, last year? And I don't want to get political with that, but it was largely the press, I think, that stopped that working. Whether you agree with it or disagree with it, that's what they tried to do, and immediately we saw the reaction. So, but no, I don't see a borrowing to fund tax cut sort of approach going forward. No.
Okay. Next question. As a UK expat, can I start contributing to my national insurance pension in the UK if I've never worked in the UK?
So we have if you have a national insurance number and you're a UK citizen with an NI record, you need at least 10 years in order to have any state pension. I've never seen that done actually, Kieran, but I don't think there's any reason if you have an NI number why you couldn't backdate it. So yeah, I think the answer to that is yes, you can. Most people, of course, that we deal with can backdate their NI contributions and already have a record. Maybe they don't quite have 10 years. I've never looked at that specifically, but I see no reason why someone who is a British national with an NI number, why you couldn't literally start to accrue as an expat your national insurance record. Yeah.
And how about if you're not a UK citizen, but you have worked in the UK, so you've got a national insurance number, you now live outside the UK. What about in that situation?
I've never checked that specific point, so I'm sorry, I can't definitely give you an answer on that. We need to look at that one and go back to you later.
Okay, no problem. How does a new LTA, oh, sorry, I'll start that one again. How do changes to the LTA impact when moving the pension into an international SIP?
Okay, right. So first of all, though, there is no such thing as an international SIP. It's either a UK registered pension scheme or it's not. It may be a SIP that is a UK registered pension scheme that's marketed internationally, because not all UK SIPs will take on board non-UK resident clients. But if you're talking about a UK self-invested personal pension with a UK-based trustee, well, then that's still a UK pension scheme. So by transferring from one scheme to another within the UK system, that is not on its own a benefit crystallization event. That is not going to test against a lifetime allowance. So the changes have no effect on that whatsoever. Excuse me. But what does happen is if you transfer out into, you may be referring to an international, when you say an international SIP, you might be referring to a QROPS, a qualifying recognized overseas pension scheme, where the trustee is not in the UK. Typically, they're out of Malta, Gibraltar, Australia, or New Zealand. They're the key 4 jurisdictions for that. Well, then the transfer into a QROPS is a benefit crystallization event. And yes, the test against a lifetime allowance does then apply. So that is an opportunity over the next 12 months at least to avoid any tax, particularly on larger pensions or pensions that might become large and exceed the lifetime allowance later. Yeah, that is a potentially very good idea over the next year or so.
Okay. Next question that comes in from Gary says, hi, if I transfer my pension to a QROPS, but then return to the UK in a year or two, what will happen to my QROPS?
Okay, yeah, good question. Well, you are allowed to transfer your UK scheme into a QROPS with 0 tax disadvantage, provided you either live in the country where the QROPS is, which is the case normally with Australia and New Zealand, or if you're transferring it to Malta or Gibraltar, you need to live in the EEA or Gibraltar itself or the UK, interestingly. So going back, let's say you are working and living in France, you transfer to a Malta QROPS. If you then move back to the UK, that is not a problem. You've transferred to a QROPS, you've created that benefit crystallization event, you've avoided the lifetime allowance tax charge, and if you go back to the UK, there's no disadvantage of that. It's now taxed from an income point of view in the UK, just like a UK personal pension would be, but at least you've avoided that international charge by transferring it internationally, you've avoided that lifetime allowance tax charge for sure. So yes, it needs individual advice, but it's the likelihood is that there are advantages of doing what you've just described there.
Okay, sounds like there's a theme here on the advice side of things.
It's so important here and now. I mean, I know we love it when, of course, things happen that require advice, and that they happen pretty much every budget. But this time, this is such a complicated and very specific area. Each individual client needs to assess their own personal circumstances. Depends how old they are, depends where they live, depends if that place has tax that locally, depends if they might return to the UK, depends how big their pension is. There's so many factors to bear in mind here. It's impossible to educate in a sort of 45-minute webinar. We need to speak to you individually and assess your own circumstances.
Okay. Next question from Thomas says, and you might need your crystal ball for this one. If you decide to move your UK pension into a QROPS and then Labour changes the rules, will the rules apply from submitting the request or once the pension has eventually moved? And how long can this take?
Okay. There was a change to the rules. You do need a crystal ball, Kieran, is the first point I'd make here, because I can't say with any certainty whether what I'm about to make as an educated guess will actually happen or not. But when they changed the rules in 2017, it was March of 2017, and they changed the rules so that you had to live in the same country that you were transferring out into your QROPS, or you had to live within the EEA, as I was mentioning earlier. So this rule change happened, and I personally was in the process. I just moved out to Dubai, and I was in the process of transferring my UK pension into a QROPS, but it hadn't completed. And then they made these announcements in the budget. I think it was around about the 13th of March or something. And I had 6 hours that day to complete the complete the transfer of my UK scheme. But because I had made substantial strides towards doing it, it was clear that my intention was to do it. The rules allowed me to actually have the money transferred later. I just needed the paperwork in place by midnight of that particular announcement date in order to show that I had made I'd showed my intention to do that. So there is a track record for that. There is sort of past form on that applying. I can't guarantee that would happen again, but that was the case when they made CUROP's rule changes back in 2017. Now, how long does it take? Or how long is a piece of string? Depends on who your trustee is. And there are some trustees that make it really hard to transfer over. They're sort of trying to hold on, I believe, to the assets under management, or maybe they're trying to mitigate any risk they may have as trustees for transferring out. When so many scams are going on now around the world, you've got to make sure as a seeding scheme trustee that your client is not being scammed. So there's an element of self-preservation that delays it. There's an element of holding on to the assets they have under management that delays it. Defined benefit schemes take longer to transfer than defined contributions. So it's impossible to put a number on it, but it's not likely to be less than a couple of months, and it could be as much as a year. It could be longer if the trustees do raise various concerns. So again, I'm sorry, Kieran, it comes back to this advice thing again. You need help. You need to approach the trustees in a way that we know we can in order to allow them to release it as quickly as possible. So yeah, this is not a DIY industry anymore. You have to take advice.
Okay, and we'll just finish on this, and I'm sorry, there are a few more questions in there, but what we'll do is we'll note them down and provide some feedback afterwards on an email that will go out, because there are just so many. The final question comes in from Stephen, who said, what sort of options are there for a UK national, now a resident in Spain, in order to mitigate UK inheritance tax? Isn't there some sort of issue with where I'm domiciled? It's very confusing.
Yeah, it is. And this also needs specific help, really, because it depends how old you are, depends what your intentions are as to whether you're going to stay in Spain, if you're retired there or just working there short term. So your domicile, I mean, this is I have a webinar on this on its own, but there is a concept of domicile, which is what drives your inheritance tax position. And if you're UK domiciled living anywhere else in the world, you still have an inheritance tax liability on your global estate when you eventually pass away. So you need to put planning in place just as you would if you were living in the UK. Various types of trusts can be used. There's a type of pension called a QNUP, a qualifying non-UK pension scheme, which can be sometimes used. In Spain, actually, there's a couple of companies that market what is effectively a QNUP that can mitigate Spanish income tax a little bit, but maybe could also help your UK inheritance tax position. So we have advisors based in Spain that can help with that, of course. So please feel free to reach out there, and maybe after the event we can go into more detail. But yes, you're right. Your domicile drives your inheritance tax position, and if you're UK domicile by origin, that is likely to prevail and stay with you for life until you make a permanent and undoubted new home in a new country.
Okay, fantastic. Thank you so much, Darren. Just to touch on the point of the questions that have gone unanswered as well, because there are so many and some of them are indeed quite case specific. So thought it easier to not go through them. After the session, what we will be doing is sending out an email, which will have a meeting booking link. So please just click on there and find a time that suits, and we can arrange a time where you can speak with an advisor and Darren, if need be, to come in and answer the more complex questions, because we want to make sure that everyone has their questions answered from this session. But for now, Darren, thank you so much today for sharing your encyclopedic brain with us and going through the 130-page budget to make sure that we all got the best bits out of it. So thanks so much for joining us, everyone, from home or work or wherever you are, and have a good rest of the day.
Thanks, everyone.